Hi there, it's Mark Carrozza, Regional Director of Multifunds, and welcome to the First Time Seller Series. This is a 10-lesson series presented by Mazan Partners, and each of these lessons can be watched on YouTube under the search Mazan Partners First Time Seller Series. Today, I'm joined by Casey Corey, founder and president of Mazan Partners, and we're going to dig into lesson number 7, continuity and succession planning. Now, before we get started, please share this video with your colleagues. Maybe they're considering selling their practice, and this video has just what they need to hear. All right, so let's go ahead and get into it. Casey, I'm excited to dig into today's topic. But before we do, as I always ask you, please tell us a little bit about Mazan Partners and why you decided to create the First Time Seller Series.
Mazan Partners is a 25-year-old mergers and acquisitions consulting firm. We founded it in the Dallas-Fort Worth area. Today it's in the Midwest. And we, obviously help advisors, both buyers and sellers, come together to execute acquisitions and sales. Also, succession planning has, from almost our inception, been a big deal to us and a big part of what we do here. So that's essentially who we are. We designed the First Time Seller Series kind of around the First Time Buyer Series, which makes probably more sense. But the First Time Seller Series is really acknowledging the fact that sellers generally only sell one time, and buyers can buy, multiple times, and quite often do, and they get better at it every time. So essentially what we're trying to do is level the playing field a little bit for sellers by giving them information that they can use when they're looking at a buyer, assessing a buyer, negotiating the deal. And while the reason we're doing succession planning is that it's an internal sale, so kind of follows that track.
So recently, Casey, I read a study by Dimensional Fund Advisors, and it indicated that 44% or less than half of the firms out there have a succession plan in place. Now, I've worked with you for quite some time, and I know over our time together, succession is a major buzzword, and especially over the last 10 years. So why do you think this is, that we're seeing the lack of advisors adopting this very important part of their business?
Yeah, there are a number of reasons, many of which are the same as why advisors never sell, outright, are applicable to succession planning. I am familiar with that DFA study, and it also indicated that the top deal breakers, things that make people not sell, were a lack of investment philosophy alignment and firm cultural fit, which is really important in succession planning. Both of those items ran around 82% of advisors are saying that, that's the reason they don't do it. Another one will be that we'll talk about in a few minutes is that, you can't find the right person. You can add to that a number of fears. One is not knowing what to do with yourself post-retirement, fear of losing your identity as a trusted advisor, which is a big one. That's kind of seductive to be a trusted advisor, and you lose that after a while. Not finding an appropriate advisor, as I said, is a really big one. And in some cases, not having enough money to live on after you've been paid off. So you give somebody 2 or 3 times revenue, and at the end of that, they go, what am I going to do in year 4? Because I've been living off this as a cash cow. So those are all reasons, among the reasons why advisors sometimes don't sell.
So,
or set up succession plan, excuse me.
Yeah, set up the continuity and succession plan. And so I guess with all of the reasons that you just gave us, why would somebody want to create a plan? It's pretty complicated.
Yeah, I mean, we talked a little bit about this in the last lesson. The presence of a plan demonstrates to affluent clients that the firm will be there to help them, even if the founder is not or cannot be. It helps bring on new clients with higher asset balances. I've got a fellow right now I'm talking to that, he's got 300 million, but he realizes that some of the times he's not getting the higher asset balances because he's a sole practitioner, and he needs
Okay.
someone that they can say that person's going to be there, the firm's going to be there. It increases the chances that you can hold on to valuable staff. Staff members want to know that there's going to be a job there. If you are in acquisition mode, and not really ready to retire, but or thinking about it, it gives a seller that you might want to approach confidence that he or she can be paid because the firm will be there and his or her clients will be taken care of. In fact, when we buy a book or a practice from someone who's over 55, we want to see a succession plan in place, because we want to make sure that the buyer, we need the buyer to have one in place so that we can prove to the seller that it's a good time to do it, or that they'll get paid. Um, as we discussed in the last session, you can get complete control over the process, which you cannot necessarily get when you're doing it externally. The timing of when you want to retire and on what schedule, meaning that you can step back and work less in stages, as someone within the firm, assumes your roles and responsibilities. The price you want for it, of course, you got to find somebody who's willing to pay that price. But it is easier to get a higher price when there's a bigger chance that the transition will be, high. And what better way to do that than to do it internally, where the clients are not moving anywhere, they're just
Hmm.
staying with the firm. The terms take in a lot of elements, but the timing of when you receive payments also can help you maximize the tax efficiency. And that is an easier thing to set up during a succession plan.
So what's needed to set it up? What's needed to set up that plan?
Well, first it's a written document,
Hmm.
defining what you want to happen after you're gone, or if you're not around, because of disability. Remember that you should not set up just a succession plan, but instead a continuity and succession plan.
Hmm.
The
Hmm.
continuity provision, or the so-called guardian provision, is the most critical because it's really your insurance against business interruption, due to the owner or lead advisors being incapacitated or dying. We've had lots of advisors that have been out for a while and come back, and I'll mention that again in a minute. You want to define, the staff roles and who will take over your duties if you're unable to do them. You want to decide who's in charge, which is a big one too, because when the lead person is gone, everybody's sort of looking at each other, and you end up with a pass the buck mentality if you don't define
Hmm.
it. This is why sometimes it takes more than one advisor to be that successor. Who's going to lead marketing? Who's going to be in charge of investment management? Who will be in charge of financial planning and service? Who makes the decisions on operational type things, budgets and all kinds of things? Anything really that you would be doing as the founder owner needs to be assigned to someone to take care of if you're not able to do it, because otherwise you're not going to have continuity of service for the clients. And in some cases, you may not have a firm to come back to. I got into succession planning years ago because my best friend's father died and without a succession plan, and his wife had to go back to work at age 70 because there was no money anymore,
Hmm.
So, and he had 5 offices that he owned. but they all just fell apart. Even if you don't
Brutal.
intend to adopt a succession plan during your lifetime, please set up a continuity and succession plan in case you become disabled. Continuity plans for business interruption are required by the SEC and are, for RIAs. And what interrupts business more than having a long-term disability of the primary advisor to the clients? And by the way, if you're in a broker dealer, I suggest highly that you read your agent's agreement or your agreement with the BD to see how death and disability are handled in your absence. You might be surprised, and I seriously doubt it'll be pleasantly. Succession comes in the case if you can't return to the business. So that's the default. That's the worst
Mm-hmm.
case scenario. We have had advisors become disabled for as much as a year and would not have had a business to come back to if that plan had not been in place to instruct everyone what to do and who was to do it. If you want a little bit more incentive, the stat is that 50% of people over the age of 65 who become disabled will be disabled for 5 years or more. And I think about that
Yeah.
because I'm 67. So
Yeah.
you want to
And
make
that would have a huge impact on your
that'll,
business. 5 years.
a few months, if you're mostly advisory, a few months you can probably get away with, but you not 5 years, not even
Five
a year
years.
usually,
Mm.
because the clients start to wonder where you are. Um, so to execute a plan, you must either have someone in the firm who's ready to take over, be willing to train someone, or be willing to recruit or merge with another firm, merge somebody into your firm who will be appropriate for the clients. Not having the ability to find an appropriate successor is probably the number one reason why a large percentage of individuals don't set up a plan. So the first thing you do is you create the plan first and then go find the person, because you can use the plan to help you attract someone. If you do it the other way around, and we see people do this all the time, where they find somebody they like and then they create the plan, but they end up in negotiations that go on for years without a resolution. I'm talking to somebody right now. They've been talking for 4 years on it, and they haven't been able to come to an agreement. If the plan had been in place ahead, and then the individual decided to join them based on that plan, that problem wouldn't have been there. Remember though, as long as you are physically and mentally able to, you can make changes to the plan right up to the moment when you can't do it because you aren't physically or mentally able to do it. So that gives you some leeway there to make changes, and I've seen that happen quite often too. So,
Well, that is definitely complicated, and there's a whole lot that goes into it. So I guess that leads me to the question, how do you find that internal successor or continuity partner?
that's a $64 million question, probably. Ideally, as I indicated, if you have an advisor or someone who can run the firm for you, then that's the first option, even if you have to train someone over a couple of years to do it. It often takes two people, as I said earlier, to replace one founder, but really what you're looking for is talent. You think in terms of the talent that is needed. You might have one person who's a strong marketer or even salesperson, if you prefer, and another person who's a good, strong administrator or money maker or a money manager. Depending on the firm, it often takes both, and it's fairly rare to find both skill sets in one person. We set up a lot of succession plans over the years, and we almost always need more than one person to fill all the roles that this founder had, because they were somebody that was a visionary, but they also got it done.
Mm-hmm.
If you don't have anyone that you trust to run the business in your absence, and you want to have an internal continuity and succession plan, you're going to have to recruit one. We've been doing this kind of work for 20 years, and I will tell you that it is difficult to get it right. Some people do it 2 or 3 times before they get it right. It is tricky, but if you're committed to it, it is perhaps the best way for all parties, including the clients, for a founder to move into the next phase of their life. So here's a few steps. First, determine what your criteria for a successor would be. It's fairly rare or hard to find sort of a mini me, a junior you, somebody that looks just like you but is younger. You're looking for someone though that does share your values about everything from money management to how you service clients, how you treat clients, and staff, investment philosophy, numerous things. So you look for those things in someone that are common to the way you think of things. Then you sit down with your staff and you sit down and write out what qualities and characteristics you're looking for. The reason you're doing this with staff is because this person's going to be integrated into your firm and they got to get along with these people. When you have a giant firm like, I don't know, Fidelity, and you got thousands of employees, if somebody doesn't really fit in, everybody can kind of walk around them and ignore them. When you've got 4 or 5 people in the office, or even 20, somebody doesn't fit in, it can be disruptive to the rest of the staff. So you need your staff to give you input on that. Doesn't mean they're making the decision, but they're giving you stuff. But you might look for things like credentials. Does that matter to you? Frankly, does that matter to your clients? Have you been selling your clients for the last 20 years on how important a CFP is? Well, you might want to recruit somebody with a CFP, as opposed to somebody that doesn't have one. What are their assets under management? If your firm is a fairly good size in AUM, is bringing a tiny guy in going to make sense? Number of clients. Does this person have capacity to service more clients? Because you're going to ask them to do that. How old are they? It doesn't make any sense to recruit a 65-year-old if you're 68. You generally want somebody at least 10 years younger than you are, or else you're going to be doing this again in 4 or 5 years. Type of clients or average account size. In other words, would their book, if they bring a book over, would their book mess up the way that you do things? Would it be disruptive to the way that you manage? So if you have, like I have a client who says that he has to break even, he has to make $4,000 a year on a client. Well, if he brought in someone who everybody was bringing in, $500 a year or $1,000 a year, then he would have to have a service model that fit that, meaning he has to recreate the wheel. So you don't want that. How they manage money, do they do it the same way you do, or are they polar opposite? You don't want them doing polar opposite. You can't bring a Gray and Dodd guy in if you're a technical analysis, person, have sold your clients on that. How they service clients. What is their service model? How often do they see clients? Or are they at least willing to do it your way? And then annual revenue. And the reason you worry about that, frankly, is you don't want to go in deficit spending. Deficit spending is when you bring somebody in and they're not bringing in enough money to cover what you're going to be paying them to be the successor. And so you want to make, especially in the early years while they're growing into your firm, you want them to bring in revenue that will offset your cost. So you get all that together. Now you're looking to create your own value proposition. You've identified what you want. Now you've got to prove to them, that person, that you're somebody they want to join. So what is it about your practice that would attract a buyer or a successor? Or a continuity partner? What can you offer the advisor? Are you going to offer them equity right away, or when are you going to do it? What do they have to do to get that equity? Again, if you've got a plan, you'll know. That'll already been defined. Training, if you're going to need to train them, even if they're a very good advisor, you're going to have to train them on your way. Who's going to do that? clients to service and earn, so they can earn when they're doing it. In other words, can you assign them a few clients right away, A, to find out how they do it, see how they do, and two, they can earn a little bit extra money by servicing those clients for you. And we used to say expertise, there was, your expertise was something that would really attract them. But, we're kind of not fooling ourselves anymore. Most younger advisors think they know what you know. They don't, but they think they do. And, so that's not really a carrot anymore. You're just the one with the book. They may, I mean, they certainly need to respect you and respect what you've accomplished and all that kind of stuff. But they, in their mind, are thinking, well, I know as much as he does. He's just got more clients than I do, and he's been doing it longer. That's the mindset that they have. Simultaneous to those two things, the value proposition and your criteria, you also want to create a plan for your due diligence. Don't go into this thing and just, all right, sort of haphazardly. A lot of plans fail because the founder did not do sufficient due diligence on the candidate advisor and his or her book. You really want to get in there, and we're going to do a whole lesson on due diligence. In fact, it's, I think, our next one. But you want to ask for production, proof of production, proof of look at their investment mix, look at tax returns, even their onboarding process. How do they do that? Get samples of their financial plans that they've done. What investment style do they favor? In short, look at them as if you were buying their book, because in some ways you are buying their book, especially if they come in and you give them equity, commensurate with what they're bringing to you. Meet them socially outside the office. Get to know their spouse or significant other. You want to see how they treat waiters. I mean, you want to see how they treat people, because you're going to be putting them in front of your clients, and you want to make sure that this is somebody that your clients would like. And you're not going to know that unless you see them in a setting outside of your office. Probably the worst thing in the world for this kind of stuff is what we're doing right now, is sort of a Zoom type of a thing, because you don't get to see the interaction between people in the same room. You need to do that in order to know whether this is the kind of person that's going to be good for you. And then the last thing, obviously, is finding them, which is the most challenging thing for most everybody. You can buy a book with a younger advisor in it who was not an owner, or who was an owner, who will come into your firm and take over. A lot of people do it that way. They'll look for a book or a practice to buy that contains a servicing advisor. Some people call it junior advisor, a servicing advisor who will, who they can groom, for the next step. And it's very attractive to that person, because that person may not have even had any kind of ownership in the old firm. You can go to your broker dealer, or if you're with a large RIA, you can go to them. I'm quite sure they'd be happy to help you find someone, because they want to maintain the assets. They don't want you going somewhere else. Conferences, obviously thousands of advisors go to conferences. That's a good place to meet people. Professional groups in your area, CFP, financial planning associations, estate planning groups, any place where advisors populate, and you can meet them and kind of see them under another scenario. You can run ads. It's probably the least effective, but people do it, and they've had success with it. Get a list, like from Discovery Data or somebody like that. Make a list of everybody that's, say, 35 years old to 50 years old, who's been in the business at least some period of time, and send them a letter. I wouldn't do it yourself, because you don't necessarily want them to do that. But you get somebody within your office who can use their personal email and say, in general terms, my client or my firm is looking for a successor. And you tell them a little bit about the firm, but you don't tell them enough to know who you are until you get a chance to look at their background. Recruiters, there's one on every corner pretty much, and recruiters can be effective if you give them the criteria and the value proposition, and they're able to follow that. Consultants like us, I mean, we use a recruiting methodology to find candidates for succession. When we do a succession plan for somebody, we execute the plan by finding the people. And there are others like us, but it's a little bit further than just being a recruiter. And then of course your friends that are advisors, maybe younger friends, or maybe they got a son or a daughter. One caution on that last one though, just because they're friendly with somebody does not make him or her a good successor. Be careful not to cut corners on the due diligence. Do your due diligence on them just like you would an unknown person. I'll finish with a comment on the agreement that you have with any potential successor. That's part of the plan. We recommend what I call a prenup. You can call it an escape hatch if you want, that gives you, both you and the advisor, an out in the first 6 months to a year, because there needs to be an exit plan just in case, because if you never know, you can contact me if you want to know more about that. But essentially what happens is you can do all your due diligence in the world, but until you sit next to somebody for 6 months or a year, you really don't know if they fit in. And so you want to have an exit strategy just in case that's the case.
Well, Casey, I want to thank you so much, and I've really enjoyed our time today. This has been a great lesson, an insightful lesson. I hope we've given financial advisors that are considering selling their practice some powerful insight. And as you said earlier, the next lesson, number 8, due diligence. In the meantime, please send your confidential questions to mark.carosa@multi-funds.com or see Corey at mazonpartners.com. And until next time, here's wishing you and your clients health and prosperity.
Thank you, Mark.
Thank you, Casey.